Welcome to The Explainer. Today, we are going to completely demystify the business model of banking. We all use banks, right? But very few of us actually understand the invisible machinery churning away behind the scenes the moment we deposit our hard-earned cash. Okay, let's dive into this and uncover the true cost of banking. Here's something that might freak you out just a little bit. Think about the money you have sitting in your bank account literally right now. Where is it? Most of us, we naturally picture this massive, heavily guarded steel vault, maybe even a cute little locker with our name on it, sitting safely at the local branch. But the reality? The reality is completely different. Yeah, the vault is completely empty. Cue the tumbleweeds. Your money is not sitting anywhere. It's for sure not in a vault, and in fact, most of the cash you deposited isn't even in the building you just walked into. So where on earth did it go? And more importantly, how does the bank take your specific deposit and use it to generate massive profits for itself?
To figure that out, we need to look at Section 1, the core engine, and we'll do that by tracking a simple $100 deposit.
Let's simplify the entire financial system down to just one customer and one bank. You walk in, hand over a crisp $100 bill and put it into a savings account. The bank smiles and says, "Hey, we'll pay you 4% interest over the course of a year." Sounds pretty generous, right? But here is the real trick. The bank doesn't just hold on to your $100. It turns right around and lends that exact same $100 to someone else, maybe a guy taking out a loan to buy a new car. Only they charge that borrower 8% interest.
So the crucial point is this core concept, the net interest margin. At the end of the year, the car borrower pays the bank $108. Then the bank turns around and pays you your promised $104. The difference between those two numbers? That's the net interest margin. And let me tell you, it is the single biggest engine of bank profitability in the whole world. The bank simply pockets that $4 difference. That simple $4 is the invisible, extracted true cost that basically funds the entire banking system. The bank is just acting as a middleman, skimming a profit from the spread between what it pays you for your money and what it charges someone else to use it. Now that we know how the engine works, let's examine Section 2, systemic cracks, and look at the inherent risk of banking. Here's the thing, because banks typically lend out 80% or more of all deposits, a pretty obvious and terrifying problem pops up. What happens if you show up wanting your $100 back, but the bank already lent it out and the borrower hasn't paid it back yet? If panic spreads among depositors and mass withdrawals occur simultaneously, suddenly the bank just runs out of cash reserves. And this isn't a flaw in the system, it literally is the system. Banking only works because not everyone asks for their money back on the exact same day. Even a completely healthy, totally profitable bank cannot survive a true bank run, simply because the cash isn't actually all there. When the system breaks, it's almost always due to this deadly combination. First, the mass bank runs we just talked about. Second, a high volume of bad loans. If a bank gets reckless, lending out way too much money to borrowers who ultimately just can't pay it back, the bank ends up with a massive hole in its balance sheet. Heavy withdrawals plus loans gone bad, that is exactly what has triggered real bank collapses in the US in recent years. This inherent fragility is exactly why banking regulations exist in the first place. To stop panic before it even starts, strict safeguards are put in place. In the US, the Federal Reserve requires banks to keep a safety cushion of cash on hand. Furthermore, institutions carry deposit insurance through the FDIC, which protects individual depositors up to $250,000 if a bank fails. That number acts as a psychological firewall. It's designed to keep you from running to the bank in a total panic. Let's move to and see how this builds into our next concept, Section 3, the pivot to fees and the literal cost of low interest rates. The traditional model works perfectly when interest rates are high, but think about what happens when that gap disappears. In some countries, like parts of Western Europe, loan interest rates have historically dropped incredibly low, sometimes even under 1%. If a bank can only charge a borrower 1%, how on earth does it profit? There's barely any gap to work with. The traditional net interest margin gets completely squeezed out. When that margin shrinks, the true cost shifts directly to you, the consumer. Banks just shrink the other side of the equation. They drop the interest they pay you on your savings account to nearly zero, sometimes literally 0%. And to survive, they start charging fees for absolutely everything. Monthly maintenance fees just to hold your money, overdraft fees, minimum balance fees, wire transfer fees. These might look like small change individually, but at scale, they're a massive revenue engine that replaces the lost interest margin. It sounds completely backwards to actually pay a bank to hold your money,
But in low-rate environments, that's just reality.
And honestly, interest margin and fees aren't the whole story either. Banks are also heavy investors. To supplement their core lending business, they take the deposits they hold and park that money in government bonds, gold investments, and the stock market, aiming to earn additional returns on top of their standard day-to-day operations.
And this brilliantly illustrates the other side of the ledger, the expenses. You might think running all those physical bank branches and massive computer servers is the highest cost, but actually, the biggest expense for most banks is their people. Salaries, bonuses, and benefits typically eat up a staggering 30 to 40% of a bank's total operating expenses.
So how do we actually know if a bank is doing a good job managing all of this? We look at Section 4, the scorecard, which is all about measuring a bank's health.
If you're ever nerding out and reading a bank's annual report, this is the very first number you want to find. Net interest margin tells you exactly how profitable a bank's core lending business really is. For a large bank, a margin in the 3 to 4% range is considered totally solid. It proves the bank is successfully and efficiently converting your deposits into cold, hard profit.
The second vital metric is the NPL, or non-performing loan ratio. This is simply the percentage of loans on a bank's books that have gone bad and probably won't ever be repaid. Regulators watch this number like hawks because it tracks the actual toxicity of a bank's entire loan portfolio.
There's a really stark contrast between a healthy bank and a struggling one when it comes to this ratio. A healthy, well-managed bank will keep its non-performing loan ratio under 2%. But once that ratio starts creeping up towards 7, 8, or 9%, wow, you are in the major warning zone. That is a massive red flag, signaling that a huge chunk of the money the bank lent out, money that originated from depositors exactly like you, might never come back. At the end of the day, banking is a heavily, heavily regulated industry. Entities like the Federal Reserve, the OCC, or state banking authorities exist to make sure banks don't get too greedy with your money. Because if you strip away the fancy marble floors, the slick mobile apps, and the complex financial products, trust is the entire product a bank is actually selling. If the public loses trust, the whole system just grinds to a halt. Which leaves us with this final thought. We often view banks as these impenetrable, monolithic institutions. But is banking an impossible monopoly or just a learnable playbook? The wild part is, starting a bank isn't some impossible fantasy. It really just requires meeting minimum capital requirements and getting regulatory approval. It's a real business model with clear, learnable mechanics based on interest margins and risk management. Understanding this totally changes how you view your money, your fees, and the true cost of the global economy. I hope this explainer empowered you to see right through the vault doors. See you next time.